Let's delve into some numbers now from a JSE listed company. They came out last night, but we didn't have time obviously to review them then, so let's do so now. The company's name is Invicta Holdings. It's been a darling of the stock exchange for quite a while now, and with good reason. Let's have a look at their year-end numbers to the end of March of this year. Profit up 55%, normalised earnings per share up 14%, dividend at 179 cents, maintaining a cover of 2.75, operating profit up 47%. There is a once-off gain in that one though, I'll speak about that later on. Revenue 35% higher to essentially 7.6 billion. 1 billion of that also is to do with acquisitions. In the studio with me now to go into the numbers is Arnold Goldstone, who's the CEO of Invicta. Arnold, another good solid set of results. As I said, there's been a couple of once-off numbers. Perhaps you could clarify what's been going on over the last year.
Yes. Well, a good year. Thank you. Appreciate that. What's interfered in our operating profits has been a lot of IFRS noise. The accounting rules dictate that you have to make certain adjustments for accounting reasons rather than for operational
So the
reasons.
bean counter's interfering again?
Unfortunately, I wouldn't. Yes, they have been interfering. I wouldn't say again, but certainly in my lifetime I've seen introduction of rules that are then taken away and then reintroduced again, as we have found now. Yeah. And unfortunately, one only discovers these things towards the end of the year if there's been a change. So yes, we've tried to filter that out by reflecting normalized earnings, which we are very comfortable with at 14% increase.
Last time you were in that chair, we were talking about Kian An, and that has added, I think, 1 billion to your revenue coming in up 35%. Is that correct?
No, that's not correct. It will in future add 1 billion. It's only been in for 2 months, so roughly 170 million added to the revenue. On an annual basis, it will be 1 billion, you're correct. And a nice business, which gives us an access to the international stage in products that we understand, with proven management they were the founders of the business, and they own 25%. And a great starting point for an international arena.
That gives you exposure to 50 countries, I understand,
which
is quite a jump. I mean, that must mean a lot to a CEO. That means probably you're going to be spending around about 6 months of your year flying to 50 countries, or at least a lot of your time in Singapore.
Not only my time, but my executives who will be focusing on that business. But having said that, the management there is sound. One of the regional founders, who is now approaching in his 70s, he's still involved in the business. So there is a steady hand at the helm there. We hope to add value with our, let's say, approach to the Western world. But the business there will continue as it has in the past, and hopefully we'll be able to add a little bit of impetus to growing the business there.
So this was really a globalizing event in Invicta's life, I think. Yeah. And I think one of the reasons, and we've spoken about this before, is because you want to diversify geographically, and also because maybe it's a fear that your traditional markets might be slowing down.
Quite right, yes. We took a view on South Africa 2.5, 3 years ago. And our sense was that South Africa was reaching almost a stagnation point as far as growth is concerned. And historically now we've been proven correct. For that reason, we decided to diversify geographically, but stayed in our business industries. So yes, we looked for an exit from what was a stagnating market in South Africa.
Is it still stagnating? I mean, let's look at the segmental analysis of the last year from your businesses, maybe starting with Bearing Man.
Sure. BMG supports and operates in the industrial and mining world, which we needn't go into detail. There's trouble and strife in that market. Yeah. Having said that, their revenue was up 25%, largely because of a small bit of organic growth, but a big contribution from their acquisitions. Nevertheless, the industry itself is a bit stressed. BMG has therefore started looking beyond the borders of South Africa for opportunities, and that's into Africa. And we will keep our eye open for opportunities outside of South Africa.
You're talking about contracts or acquisitions?
Contracts. So servicing mines, what little industry there is in Africa, looking for that. So a bigger focus on Africa. Roughly about 12% of BMG's revenue is from Africa anyway, yes. But we're looking to make greater inroads. And there are opportunities. There are mines opening up, unlike South Africa, and there are opportunities.
Lots of competition, though, in that space to get those contracts, because everyone is starting to say the same thing. It's a theme that we've been banging on about on CNBC Africa for months, if not years. So is it difficult to find the right deal that has the right margin for you?
Yes, that is a challenge, and then also being able to service it cost effectively, because we sit in South Africa with a massive base, and that's where we have a bit of an advantage over our competitors, I would venture. We have technical support, fantastic inventory. We are bigger by far than most of our competitors, which gives us a very strong base from which to support Africa, technical support, inventory, etc. So the business in Africa is expensive though, and that's where the trade-off always comes. You seek opportunities in a small portion of a remote part of Africa, and your rewards are not always commensurate with the cost. But it's part of business,
You can't afford not to be there if that's the right way to phrase it.
Exactly.
So there might be a couple of loss leaders to start with, but establishing a base in a particular jurisdiction is terribly important for you. Let's move on now to Capital Equipment Group. How did it do?
Capital Equipment has done fantastically, 37% up in revenue, similar kind of increase in operating profit. Had a good run. 75% of that business's revenue comes from the agricultural market, which has done well. Yeah. It has cooled off a little bit since the beginning of this year. The industry stats are available. Year to date for May, tractor sales are down about 5% on last year, but nothing terrible. The construction industry has picked up as well. The construction machinery industry has started picking up. So that certainly has bottomed out. And K&N is also going to fall under that heading from now on going forward. The past year has been a good one for capital equipment, and we're delighted. The acquisitions that we've made in that little neck of the woods have been good. We've added another one, which we've just got a little bit of one more element to close off, and then that will be on board for this coming year. So we've grown the base quite nicely.
Elsewhere, building materials and other divisions.
Building materials.
What's been going on?
Interesting one. Building materials. People have different experiences in the building materials. We are having a very positive one at the moment.
That is bucking a trend, actually.
It is bucking a bit of a trend. We've chosen our niches very carefully. We had a smallish business in our lives, Tile Toria, and we've added a company called McNeil Distributors to that, which gives us an annual revenue stream of about R1 billion in that industry, mainly on the wholesale side. So it gives us a nice base. We're going to solidify that and then decide how we grow from there. And also it gives us a nice entree to Africa, because that's the one product range that we have in our stable that is readily saleable into Africa. It's a consumer type product as opposed to industrial or mining or agriculture or construction. So it suits Africa.
Let's talk about prospects now, and linked to that, your balance sheet, which is awash with cash and it's sloshing around. You've been building it up nicely, and of course you're waiting for the time when the person comes with another K&N for you and says, Arnold, look at this one, and you're going to do it, presumably.
It's a double-edged sword that one has when you have a strong balance sheet, because it's a drag on earnings. Your return on cash is low compared to what we can get as a return on our own working capital. However, we made the decision in November last year that we wanted to strengthen our balance sheet. The world was too uncertain for us. And also it would then mean two things. We could survive any unexpected bad turns in the world economy or in the South African economy, but at the same time be armed with gunpowder should we need to make an acquisition. So it served us well. Our business balance sheet is incredibly strong. But as I say, if we don't invest that, we could have a drag on earnings.